This is the headline that's garnering all the attention today.
All the evidence shows there's an investment boom going on.
Markets are looking for clues about the health of the job market.
Artificial intelligence absolutely has already been a disrupting force.
People are right to question how much longer this bull market can run.
With stocks rising, fueled by big tech and easing trade tensions.
This week, the Fed voted to lower interest rates another quarter of a point.
Take a look at futures. Now a little bit of a mixed bag. We've actually seen the Dow tick lower.
Oh boy, here we go again.
It's time to tune out the noise and tune into great information with A Steward's View. Expect valuable economic updates, investing techniques, and planning concepts that will move you to be wise and decide well. You'll be equipped and encouraged in a stewardship mindset, managing God's resources 1 week at a time. You can listen to this podcast and previous episodes at astewardsview.com. Now, here's your host, Aaron Kolkman.
Welcome back. I'm Aaron Kolkman. That's Chaz Louder, and this is A Steward's View. So glad you joined us again. Check out the weekly economic and market roundup later today at astewardsview.com/blog. Our mission on ASV is to help you cut through the information chaos of the digital era so you can be wise and decide well. That is, we work to bring light to your financial decisions as stewards. Last week, we got into a series on investment planning, and Chaz, I haven't named it yet, so if you have a name, feel free. But we talked last week about the merits of asset aggregation and a process for it. This week, we'll talk about the benefits of it. Is it about return? All about return? Or could it be about risk? Could it be about your taxes? Could it be about legacy? Before we begin, let's take a moment to examine our work in the context of God's Word about stewardship. We learn in the book of James some important points about wisdom, and you know that this is a show about wisdom. James 1, verse 5 reads, "If any of you lacks wisdom, let him ask God, who gives generously to all without reproach, and it will be given him." Later on in the book of James, chapter 3, verse 13, we hear, "But the wisdom from above is first pure, then peaceable, gentle, open to reason, full of mercy and good fruits, impartial and sincere. And a harvest of righteousness is sown in peace by those who make peace." So there's a huge distinction here between worldly wisdom and heavenly wisdom. Man's wisdom and God's wisdom. Secular wisdom and biblical wisdom. So I'll just leave that, but let's consider what kind of wisdom is it that we're really after when we have these conversations. So with a focus on God's kind of wisdom, let's get into the details of the benefits of aggregating assets. Okay, not a fun topic, if we're honest, but a necessary one. Achieving genuine diversification, I would say that is the first benefit, the reason to go through this process. The second benefit, to optimize your taxes. Okay, like pay unto Caesar. We all pay taxes, Chaz. I'm assuming you paid your taxes last year. Okay.
Yep.
Okay.
I paid
so
them.
legitimately paying less in taxes. That's a second reason to go through this process. It's a benefit to aggregating assets. And a third one, it's just to have a basic understanding of correlation, okay? And I call it the universal pie chart in terms of this whole thing that we're creating. But when we can see it all together, we start to see how the pieces are interacting together, okay? And so there's a lot there, but those are the three big things that I think we can talk about succinctly for our listeners in this episode. Genuine diversification, tax optimization, and something about correlation. Okay, so before we get there, let's take a quick break, and we'll go then right into our noise segment. And Chaz, I know you're excited about our noise segment today. And right after that, we'll get right into these points.
Investors have holdings scattered under multiple logins. Now there's one place to put it all together. Your entire portfolio in one place. Every asset house, every holding, every transaction, every day. It's called Fusion. Fusion means ongoing portfolio aggregation, without a contract and without a hitch. This important tool can put all your investments into a single view with a universal login provided by Morningstar and sponsored by Fidelity Advisors. Fusion gives its users the benefit of a constant monitor and quarterly risk-reward reports on the entire portfolio. So take a break and take advantage of this valuable view. Register now at fideradvice.com. Just click Fusion at the top of the page or type in fideradvice.com/fusion. And now back to A Steward's View. Awesome. Okay, Aaron, this is going to be a bit of an experiment I'm excited about. It's a different kind of noise thing, and I just want to, full disclosure, this is a feature I want to steal for the future. I might have Paul help me with this, or you can help me with this. It's almost like a little, I'm going to call it an investor type game, and you'll see what I mean in just a second here. It's short. There's a chief investment officer named Kevin Mann. I don't know what he's the investment officer of, but he's a market professional, right? He's an investment professional like yourself, probably multiple letters after his name as well. And he's on this show called The Street. And this woman is going to give him an example. And I'm going to not let you hear his reaction. I want yours, and you're going to match up against him. And it'll make sense in just a moment. So I'm going to hit the button here to present this screen. And again, I'm going to pause him, and I'm going to get your response. It's a one-word answer because, Aaron, I don't know if you know this, but sometimes, buddy, you're not short on words. So
I've heard that from time to time.
All right. So here we go.
Markets higher or lower by the end of the year?
Okay. Oh, this guy says higher. Aaron, what about you?
I say higher.
Okay.
Higher.
Bigger risk, China policy or Fed policy?
Or Fed policy. What do you think, Aaron?
China policy.
China policy.
Inflation, sticky or easing, Aaron?
Easing.
Inflation, sticky or easing?
Easing.
Oh, man. Rate cuts in 2026.
Few.
Oh, man, Aaron, this is killer. Bigger market mover, tariffs or rate cuts?
Tariffs.
Rate cuts.
Okay.
Q3 earnings, boom or bust?
Aaron?
Oh, boom.
Boomish.
Okay, that was not an option.
Bull or bear?
Oh, come on. I got his response. What do you think, Aaron?
Yeah, I mean, moderate bull. So sure, limited bull makes sense.
You like his slight adaptation there?
Limited bull.
Stocks or safe havens?
Aaron?
Both.
Stocks.
I mean, can you have both, please? Because you can.
Dollar strength or treasury rally?
Oh boy. Neither.
You want to explain that?
Well, okay. So
Short,
dollar
short.
strength. That dollar strength is going to be hard to come by in the short term because it's got so far to come back. Treasury rally, unlikely because as we see rates lower, that's just not the way it goes.
Treasury rally.
Buy the dip or wait for a bigger pullback?
Okay. Classic.
Well, wait for a bigger pullback. There's a correction coming.
Yep. You can't wait.
Value or growth?
Oh,
For the fourth.
this guy says
No.
no.
Okay.
No.
Well, yeah, exactly. What time period? So if we're talking right away, we have to be tactical. We talk about next year. We're talking about value investing in my mind.
That's answered like classic Aaron Kolkman. You want all the details that can't be part. Of course, I get you.
Okay.
Quarter value after.
Big banks or big tech?
Big banks.
Big tech.
Gold?
Oh, Aaron, big banks, big tech. So explain your process here.
Oh, okay. Well, I mean, we had 3 years of big tech. How about we give the banks a chance? That's not just a fair game comment. That's a valuation comment.
Okay. Gold above 4,100 an ounce.
Possible.
Above 4,100 an ounce. Bubble or breakout?
Bubble or breakout.
Oh, well, a bubble in gold. I have a hard time with that idea. So let's go with breakout.
can't go much higher from there unless things seriously start to erode on the global economy picture.
He's cheating. Okay, he totally didn't
He's
even
not answering the
answer
question, right?
that. U.S. markets higher.
U.S. markets higher or lower by the end of the year?
Higher.
Higher.
Okay. And we're back. So Chaz, thank you for that awesome noise segment. So interesting what you're getting, what's coming across your desk when we're having these interactions and recording for our listeners. But let's talk concretely about asset aggregation. So asset aggregation, what does it mean? It means building a universal pie chart. It means bringing together multiple investment plans perhaps multiple investment plans into one. It means taking that one plan and making it the plan across all accounts, all different types of accounts. Okay. So what happens when we do that, and I mentioned these benefits earlier, but quickly, we're going to get genuine diversification. What do I mean by that? What I mean is that if we find out that we're holding the same fund or the same stock in 3 or 4 different accounts, and now it's 15% of the portfolio and we meant for it to be 10, we're going to find that out. Okay. This may seem very 2015 to our listeners. It's absolutely 2025 as a problem. So when we can see, okay, what is it? I mean, I run a stock intersection all the time for clients. Somebody called and wanted stock advice the other day. I ran a stock intersection on all their accounts to figure out how much of the stock do they actually own directly or through funds. And they already had like 3% of their portfolio in that particular stock. Okay. And so we want to be really careful about having these separate investment plans because we don't know what is the composition. Even when we have the individual investment plan, as I just mentioned, we need to double check, but at least we can do that. So that genuine diversification is a big deal. Why? Because, if we end up with 15% of our portfolio in a more aggressive position than we intended, we only meant to have 5 or 10% there. I don't need to tell you how that works when you're particularly in phases 3 and 4 of life. If I think about the life cycle book and the different phases of life that we go through, where we're not earning income as much, right? We're living on our assets, okay, instead of feeding our assets. Thank you, Chaz. There it is, the Life Cycle of Wealth book. Yep, that's one of the draft copies. We've got this whole new round, as it turns out, coming out soon. But the issue is genuine diversification. I'll give you another example. How much of my holdings are in large companies versus small? How much are in, U.S. versus foreign? How much are in foreign versus emerging markets? Okay, and what is the fixed income component already? Is it 10% that it's, you said you wanted? Or is it more like 5 or 20? Okay, well, those are very different things in terms of, we talk about next year and things playing out in a different way than 2025. So having this done, particularly at this time of year in the fourth quarter when we've had all these big changes in the market as far as prices, is mission critical. What do I mean? Well, when you have the Mag 7 plus about 3 names, these 10 stocks in the S&P 500 that have accounted for this huge run in 3 years' time, and we say, okay, well, I'm going to run this analysis from 3 or 4 different accounts and find out that I've got, let's say I've got 15% of my holdings in those 10 stocks. That might be okay with you, the listener. It might not. If it isn't, chances are that you started with what you meant to have at about 10%, and now you're sitting at 15, okay, because of the big run up in prices. And so that just argues for rebalancing, okay, which then argues for a tax plan. Okay, so the tax plan, a couple different angles there that I want to touch on at year end. Okay, number one, when we talk about tax optimization or tax location is another phrase for it, what we mean is considering the different account types and the tax treatment of those account types and the types of assets that we're going to hold in the different account types. Okay, so that's a lot of words, but as an example, if you take in your tax deferred accounts or even your tax free accounts, those holdings that are growth oriented and have I'll say a less favorable tax treatment, right? And hold those things in those accounts, and you take the things that are less growth oriented and or have a more favorable tax treatment and hold those in your taxable accounts. I wish I had all of that in front of me, but basically we're talking about driving down the tax cost of your portfolio just by taking the same set of holdings that we mean to have in one investment plan and putting those holdings in specific accounts instead of what? The possibility, and I see this a lot in actually very impressive wealth offices where, hey, I've got the universal pie chart even. I know I'm diversified, but guess what? I hold this tax-friendly position. Let's say it's a low turnover bond ETF. Okay. That's a bad example because of tax treatment. Let's say it's a low turnover stock fund, and I'm going to hold it in my taxable accounts. Okay. Because I'm not going to generate much in distributed gains or in turnover. Okay. Buying and selling activity. So that's a better example. So I've got that fund. I figured out it's going to be in my portfolio. It's this great manager. I want to have that team working for me, and I'm going to put them in my taxable account. Only I've got 2 or 3 taxable accounts, so I'm going to own it two or three different times. That's fine. But the problem comes when we have the same exact universal pie chart in all the different accounts, right? In other words, I've got the same pie chart going 4 or 5 different times. So that's a different thing than I'm talking about. I'm talking about aggregating, connecting all your logins, bringing them into one login, keeping that one login, taking all the assets, every asset, every day, all the history, and then looking at them and then taking each holding to only one place, to only one account, okay? Not to multiple accounts, and specifically to the account that it's best fit in from a tax standpoint, okay? So let me give you an example of what I wouldn't do besides what I just said, which is I've got a bond portfolio generating bond interest that's coming out, okay, every month, every quarter, however often. And that interest is taxed as ordinary income, typically, okay? So where do I want to put that in my portfolio? Do I want to put that unfavorable tax treatment in my taxable account? Probably not. If that's my only option, I might consider going to municipals if I have a tax issue, like a real tax planning issue with my bracket and so on. But I'm going to try to put that in my tax deferred account, right? Or my tax free account. There's a good argument along these lines, by the way, for taking your growthiest assets and putting those in your tax free accounts. Okay, and this is what Thiel was so well known for this. Peter Thiel, if I'm right, he did private equity in his Roth IRA and just went gangbusters on a tax-free asset. He owned all these businesses in his Roth IRA. So good for him. But that's an example of something that is slightly different than I'm talking about, but comes back to this idea of asset location. And this time of year, I'm talking about the tax angle in particular, right? Making sure you've aggregated, you've got genuine diversification, and then that you've given at least some thought to, okay, what is the tax, what is the expectation of a particular holding, right? How's it been? How's it behaved in the past? And what kind of tax consequence do I have just with a holding? Okay, I'm not talking about the account type, but then putting it in an account that makes the most sense given all the other inputs. Okay, so this is work. The third thing, before I go to the third thing, by the way, Chaz, it's year end. I think there's a lot to be said for tax loss harvesting, and I'll try to get to that between now and year end. We mentioned it one other time this year, but the idea that we've got a lot of gains, probably not a lot of losses as I look at what's gone on with the various asset classes globally, but at least the idea that we can rebalance, we can take, if we have room, say it this way, if we have room in tax brackets for investors to capture some gain, particularly long-term gain with a favorable tax treatment, and use that in this year's filing. That's a conscious decision. Okay. So let's leave it there. The third point, and I think this is really huge, and we're going to go into this in weeks ahead, and it's something, frankly, I staked my career on, and that is we start to get closer to asset optimization. And so I'll say it this way. When we are looking at multiple accounts with multiple holdings and different tax types and different behaviors, and we say, okay, I want to have hopefully as little risk as possible and as much return as possible. Okay. Within reason. Then what I want to do is I want to understand how these holdings work together. Okay. And so one of the most often missed parts of asset allocation, I hear advisor types come out all the time, say, oh, I got this great idea. Okay. I bet it is. I know some people way smarter than me with great ideas that I listen to that have a lot of experience and insight. The issue I have, and it always comes back to the individual and the family, that is, how does it correlate to everything else that's in your portfolio? Okay. So if you already have that asset class covered, right, this idea probably doesn't make any sense. So you've got, your large cap stock at 10%, Mr. Investor or Mrs. Investor, and you want to add another 5% because you like this idea. Well, you could do that, but I'm just going to rebalance out of some of the rest of what I'm doing then, right? So does it really make sense? I mean, often, no. So the point with correlation is that we get to find out how much, not just the pie chart itself, but the pieces within it. How are they? Is there friction there, or are they happy together, right? And if they're happy together, they're going to work harder together. And so in finance, that's called a covariance. And it's a super important, I'm saying that one of the most often missed parts that investors are, I mean, long-term investors. I'm not talking about trading. Okay. So when people are saying, okay, how am I going to position capital for the 5+ years ahead? That correlation analysis is super important. And I talk about it like, cylinders in an engine for a reason, because we want to have a smooth ride going along down the road with our assets. Okay. So we don't want to have a bunch of hiccups, a bunch of road bumps as we go, especially into the second half of life. So correlation analysis, it is available. And what you're looking for there, once you've aggregated, you've evaluated if you're diversified, you've done something about tax optimization or asset location, you want to find out how uncorrelated are the assets, the holdings that I have with one another. Okay, that's the question. So what we don't want is a high degree of correlation. We don't want everything to go up together and everything to come down together. Okay, this is one of the reasons I pick on dividend investing, because the person that doesn't sleep well at night with, a strong equity portfolio, as cool as it sounds, as interesting as it is, as fun as it is to talk about, the correlation analysis is everything's correlated. There isn't one. It's just going to move up or move down altogether, all at once. Okay. And the fewer stocks you have, by the way, or the fewer holdings, the more volatile it is. Okay. Now, there are exceptions to every rule, but those are the issues. So correlation analysis is very important. Looking for, how do I smooth out this ride? Okay. Once I'm diversified, I'm hopefully tax optimized, and now I want to have a good experience. I just want to know that I have a low or negative correlation between the holdings that I have so that they work well together. And I like Chaz to say 1 + 1 = 3. Okay. That's the idea with correlation analysis. And that's further into asset optimization. But I'll leave it there. Those are the reasons that I believe that aggregation is so critical. And I'll keep coming back to it over and over and over again until I stop seeing aggregation opportunities in my weeks. I'm going to continue on this path. So I'll just encourage our listeners, please do take a look at any, I say independent is number one. To find an independent place to go. My firm, Fideer Advisors, does this. You can go to fideeradvice.com/fusion and look and register there and get an ongoing second opinion about your assets. To be clear, we're not a custodian and we're not advising in that case. We're just offering you a second view of what's already happening in an aggregate way. Okay. And we'll talk about modeling the aggregate sometime soon as well. Chaz, I know you're excited.
Buddy, I'm so excited. Hey, I have a question going back to point one. This is maybe a fundamental question, but you were talking about diversification of assets, and you were talking about foreign assets. And because my brain thinks internationally, I'm a former missionary, investing nationally versus investing foreign assets. I would assume like the main thing to consider there is just like volatility in our U.S. market, and that's why you would want to be invested, in foreign things. So you're just getting invested across the board. So with regard to our politics, or because the dollar goes up and down, if you were invested in Japan or China or some other country, you want to speak a little bit more about that? Because you talked about it as if like, hey, there's a different strategy for each of these different types of diversification situations.
Right. So I'll say it this way. When I'm looking at where in the world to invest, what I'm not looking at is what's the name of the country or what's the name of the asset class. What I am looking at is what is it that I don't already have, right? That's either doing one of two things, either contributing to the overall. I mean, we're way past manager selection here. We're just at a very high level, and we're saying, where in the world am I going to invest? And it's something that's going to drive down risk or increase return where on the overall, not just by itself. See, and so when we talk about this stuff, I think one of the confusing things is that we're used to looking at one account. We're used to looking at accounting, financial accounting, from our custodian, from our 401k provider, right, or the asset house. So this is different. This is saying, okay, when this particular holding, wherever it is in the world, goes up, right, and it might be a fund holding, 100 different positions in Europe. When that goes up,
like a international ETF type situation.
Sure. When that goes up and something different is happening in another part of the world, okay, well, that's geopolitical probably, but the point is that there's something different happening. Okay, in the U.S., when we say, well, I've got large companies, I've got small companies, those are two different things, right? So they're behaving differently in different parts of the market cycle. So what is going to be complementary to the overall, right? To reduce the overall risk, to increase the overall return. That is usually more of a picture that we end up painting than it is, a finite set of rules that we're following. But what I'm trying to impress on our listeners is that we have to be aware of how they work together, less about where they're located or even what the market cap is, frankly. I get into manager names because I'm trying to follow people who are reducing risk and doing a consistent job of return. So that's my best answer for now is basically geography is a secondary consideration. Does that help?
Yeah, no, that's great clarity.
Hey,
I was just trying
it
to
sounds good
understand
though. It's always fun to say, oh yeah, I got this holding over in, XYZ emerging market. I don't know. Used to be BRIC, right? Brazil, Russia, India, China. Okay. That's kind of a bygone moniker now, but this emerging market that no one's ever heard of. And I bought this company that no one's ever heard of. And isn't this interesting? And it is. And there's so much cool stuff you can do. By the way, I had a conversation. Can I add something to the noise segment, even though we're not in it?
You're the boss here. Go for it.
Great. So I want to tell you this. I had a conversation, and I actually have permission to talk about this. I almost forgot. Last week, after we finished A Steward's View, I went to the gym, and I was talking to a friend of mine, and he said, I took this weekend trip, and we all talk so smart. And what I think he said, the way he said it was, I listened to a bunch of smart talk. Okay. And there is so much confusion, Chaz, about the meaning of terms and how this all fits together. Basically, the first level of all of this is we have to distinguish between, and I didn't say this to him that way, but we have to distinguish between, is it trading or is it long-term investing? Okay. If it's long-term investing, that's a different conversation. And I didn't get to go there with him because he was like 10 miles down the road into holdings and ideas and all the things. And these people he was talking to had made a lot of money. This happens in bull markets, right? People make a lot of money in a strong upward bull market. I watched this, lived it, worked in it from 2009 to 2019, right? We had this big, long, historic run. Okay. So people make a lot of money. Well, who doesn't have a good idea in that? Really, like who wouldn't look at the Mag 7 the last 8 months and say, oh, like, look at that. I just, tripled my assets in 6 months. Like, absolutely. Like those are convincing things to hear. And, hindsight's always 20/20. What I'm arguing for here isn't to fail to invest wisely. It's to say, make sure you're doing long-term investing with a singular investment plan and then following it, because when we get into the 2001s and 2s, the 2008s, a little bit of 2018, 22, right? Pretty soon, those conversations change very fast. And could people have, got in and out at the right time? Yes. I argue you can also get on a plane and go to Vegas and make a lot of money too. So I'll leave it there. There were some interesting things that I'll try to uncover with him in that conversation next time I see him. But I thought I'd mention that it's really easy to get distracted in all of this, to hear something a little bit differently than you're doing, right? And to start to question, is this really, am I doing the right thing? Mm-hmm. Yes or no? Okay. Right. And there is no perfect portfolio. Okay. But there is a good investment plan that you can work with over a long period of time that does what? That funds your goals. Mm-hmm. So I'm just glad we could talk about this. We covered a lot of ground. Chaz, anything else before we wrap?
No, brother, I think the only thing I would say is that I appreciate that clarity. I mean, especially when you've talked about something that's so dense, when you've got a lot of different stuff going on, when you say, hey, this is a trading versus an investing conversation, or this is a product versus a long-term strategy conversation. I think that it's easy to get lost in those. That's why I like those noise things, because it gives you a little bit of your insight in the bigger long-term picture and the arena that you play in. So thanks, brother. I think it's great.
Yeah, thank you. And 2026 will be an interesting year. So it's been a joy. This has been great to be back. I hope this session has been a blessing to you and others you decide to share it with. Next week on our investment planning series, we are going to get more into asset optimization. We'll get to the hard work of scoring a portfolio's risk-reward characteristics and the clarity that it can provide. So in the meantime, I invite you to connect with us online at astewardsview.com. That's astewardsview.com. From all of us here at ASV, we look forward to connecting with you again next week. Until then, please do be wise and decide well.
You've been listening to A Steward's View. To learn more about Fidare Advisors or speak with Aaron, visit fidareadvice.com. That's FIDERE advice.com. To listen to this and other episodes of A Steward's View, visit astewardsview.com. A Steward's View is brought to you by Fidare Advisors, a registered investment advisor offering financial planning and asset aggregation. Asset aggregation systems are designed to align portfolios across accounts into a single, globally optimized investment plan for families it serves. Fidare maintains liquidity of client capital at major custodians and utilizes asset managers that have shown consistent historical performance through excellent risk management. This program is not an offer to transact any securities and does not constitute a financial planning engagement. Information provided has been prepared from sources believed to be reliable, but is not guaranteed and does not represent all available data necessary for making financial decisions, and is for informational purposes only. Fidare and its representatives do not offer tax or legal advice through Fidare. Please consult the appropriate advisor. Fidare Advisors LLC is a registered investment advisor. To discuss your situation or to learn more about Fidare, please visit fidareadvice.com. That's FIDERE advice.com.